Imagine a company so vast, it touches nearly every American household. From the groceries in your fridge to the gadgets in your living room.
A real giant.
Exactly. A company that really defines convenience and value for millions. Today, we're taking a comprehensive, investor-focused deep dive into Walmart, ticker symbol WMMT.
Yep, WMT.
Our mission for you, our listener, is to give you a rapid yet thorough understanding of what makes this retail giant tick, really from an investment perspective.
Mm-hmm.
We've pulled together a rich collection of analyst reports and market insights that reveal Walmart's current position, its, surprising strategies, and its future outlook.
Yeah, there's a lot going on there.
This isn't just about what Walmart sells, it's about what makes it a compelling or maybe even a challenging investment opportunity for you.
And what's truly fascinating about Walmart, I think, is its sort of dual identity in the market.
How so?
Well, on one hand, it's that quintessential stable defensive stock, a bedrock for many portfolios, largely thanks to its massive grocery business.
Right, the stability factor.
But on the other hand, it's a company that's relentlessly innovating, pushing into new, high-margin ventures like advertising and healthcare, and constantly evolving its core retail operations.
So not just sitting still.
Not at all. This deep dive will, hopefully, cut through all the noise and deliver the critical insights American investors need to really understand Walmart's strategic moves and its financial performance.
Okay, so let's set the stage a bit. Walmart was founded by Sam Walton way back in 1962, right? Built on a powerfully simple core value, always provide the lowest prices to customers.
That's the foundation. Still is, really.
And that guiding principle has obviously propelled it to become one of the world's largest retailers, operating thousands of stores globally, selling, everything from fresh produce to the latest electronics.
It truly is an empire built on everyday essentials.
But how does a company that enormous sustain its competitive edge? I mean, that scale must be hard to manage.
Well, when we connect that foundational principle to the broader picture, Walmart's enduring strength really crystallizes around a few key characteristics. First, it's all about economies of scale.
Okay.
As the largest retailer on the planet, their sheer purchasing power and incredibly sophisticated logistics system are pretty much unparalleled.
They just buy cheaper than anyone else.
Basically, yes. This means they can buy goods cheaper and move them more efficiently than virtually anyone else, which directly translates into those low prices for consumers.
Makes sense.
Second, their omnichannel strategy is vital, especially for an American investor watching their local store. It's no longer just about brick and mortar.
Right, the online piece.
It's about seamlessly integrating those physical stores with their online websites and mobile apps, offering convenient options like curbside pickup and home delivery. It's a complete evolution from traditional retail that, crucially, leverages their existing assets.
So the physical stores are actually a competitive advantage, not just, legacy infrastructure. That's a powerful twist on the usual narrative.
Precisely. They act as distributed fulfillment centers, which is a huge edge. And critically, something like over half of Walmart's revenue comes from groceries.
Wow, over half.
Yeah. This isn't just a fact. It makes Walmart a defensive stock. People always need to eat, regardless of the economic climate, which means consistent demand even during downturns.
Ah, so that provides a floor.
Exactly. Beyond the U.S., they have a substantial global footprint, with major operations in Mexico, Canada, and China, which further diversifies their revenue streams.
Okay.
And perhaps most strategically for future growth, we really need to talk about their new business ventures.
Like what?
Think Walmart Connect for advertising. They're leveraging their immense first-party shopper data to create a highly targeted advertising network that's a high-margin business that redefines their digital play.
Interesting. Using their own data.
Absolutely.
Okay.
Similarly, Walmart Health aims to radically reshape healthcare access for millions, directly challenging traditional models. And their membership program, Walmart Plus, BELS, is a strategic counter to Amazon Prime.
So Connect, Health Plus. These aren't just side projects.
No. These aren't just add-ons. They're essential for diversification and for boosting overall profitability in the long run.
That's a fascinating pivot, definitely, especially into healthcare and advertising. But for American investors, the bottom line is always the financial health. So what numbers truly matter when we talk about a company of Walmart's scale?
Right. For a company of this magnitude, these aren't just numbers, they're vital signs. When we look at total revenue, its sheer size is astounding, of course. But the real question for an investor is how they sustain growth at that scale.
Yeah, growing on top of billions.
Exactly. Then there's net income and operating margin. Retail margins can be notoriously thin, but Walmart's stability comes from generating consistent profits through incredibly efficient operations.
Efficiency is key.
And cash flow, specifically strong operating cash flow, is a huge sign of financial health. It indicates their ability to fund all this relentless innovation and expansion without constantly needing external borrowing.
Okay, that makes sense. You mentioned growth. How do we measure that beyond just the headline total revenue figure? What specific metrics give us a pulse on their forward momentum?
Good question. That's where online sales growth and maybe even more critically, comparable sales growth come into play.
Comparable sales, what's that exactly?
Online sales growth is straightforward. How fast is their e-commerce engine expanding? But comparable sales growth, or comps, is a deeper dive. It measures sales from stores and online channels that have been open for at least a year.
Ah, so it filters out the effect of just opening new stores.
Precisely. It gives you a true apples-to-apples look at organic growth and the health of their existing operations. As of, say, July 2025, when we scrutinize their recent earnings, we're not just looking at raw revenue and earnings per share, or EPS.
Right.
We're asking whether those figures beat or missed market expectations. Specifically, how did comparable sales growth perform across both grocery and general merchandise in the U.S.? And how many customers are utilizing their omnichannel services pickup and delivery?
So are people actually using the new services?
Exactly. That tells us if their strategic investments are truly paying off. And maybe most critically for stock movement, we scrutinize their guidance.
Their forecast for the future.
Yes, the company's own projections for future revenue and earnings. That forward-looking statement often has a much bigger impact on the stock price than the past quarter's numbers, believe it or not.
Interesting. It sounds like Walmart is navigating a very complex landscape, which brings us to how investors actually value a company like this. It's often considered both a value stock and a premier dividend stock. What does that actually mean for someone looking to invest?
Well, when valuing Walmart, analysts often look at ratios like PER, price to earnings ratio, basically the price you pay per dollar of earnings.
Okay, standard stuff.
And if EBITDA, enterprise value to earnings before interest, taxes, depreciation, and amortization. EBITDA is particularly useful for comparing companies because it looks at their overall value relative to their operating cash flow, sort of stripping out financing and accounting decisions.
Gives a cleaner operational picture.
Exactly. These ratios give us a clearer picture of how the market is truly valuing this retail giant. But for many investors, Walmart's true appeal lies in its dividend yield and growth.
The income aspect.
Right. Walmart isn't just a dividend payer, it's a dividend aristocrat.
Ah, yes, I've heard that term. What does it signify again?
It means it's a company that has increased its dividend payout every single year for at least 25 consecutive years.
Wow, 25 years plus. That's consistency.
It's a powerful track record of returning value to shareholders. We also examine the payout ratio to ensure that dividend is sustainable. It tells us what percentage of their earnings they're actually paying out.
Making sure they aren't overstretching.
Correct. So for those of you seeking stable income and a long-term portfolio anchor, Walmart's consistent dividend history, backed by that strong cash flow, makes it particularly attractive.
Okay, so understanding Walmart's position as a dividend aristocrat and its massive scale,
Right.
how does it navigate the incredibly competitive retail sector? The landscape is constantly shifting, it seems.
Absolutely. The competitive battlefield is intense, no doubt about it. In online retail, we're seeing increasing e-commerce penetration and fierce competition in last-mile delivery. Consumers expect faster and faster service.
Yeah, Amazon effect.
Pretty much. Meanwhile, offline retail isn't disappearing, it's transforming. It's shifting towards more experience-driven stores and optimizing existing footprints for greater efficiency. You can't just be a big box anymore.
Right. And consumer trends.
And then there are the ever-evolving consumer buying trends. People are value-seeking, especially now, craving convenience and increasingly prioritizing health and wellness. Walmart has to adapt to all of this simultaneously.
Given those shifting habits and that intense competition, what are the most significant strategic moves Walmart is making to not just adapt, but really lead? Because the sources paint a clear competitive battlefield.
Exactly. When you compare Walmart to its rivals, its strategic advantages become clearer. Amazon remains the online Goliath, right? Dominance in e-commerce, sticky Prime membership.
The big one online.
Walmart counters this with its vast physical footprint, which it leverages, as I mentioned, for powerful omnichannel services. They offer speed and convenience like same-day pickup that Amazon simply can't replicate everywhere with a pure online play.
Using stores as hubs.
Precisely. Then there's Costco, known for member loyalty and strong bulk pricing. Very different model. Target, which has cultivated a more curated product mix and, a distinct brand image.
The Tarzay effect.
Kind of, yeah. And grocery specialists like Kroger and Albertsons, emphasizing freshness and local presence. Even dollar stores like Dollar General and Dollar Tree compete hard in the low-cost market, and they often show recession resilience.
Don't forget the delivery guys.
Right, and specialized online grocery delivery services like Instacart and DoorDash bring convenience and last-mile expertise, sometimes partner with grocers, sometimes competing.
Wow, that's a crowded field.
Yeah.
So what gives Walmart the edge specifically? What are its core strengths here?
Well, fundamentally, it's their unparalleled economies of scale and purchasing power. That allows them to consistently offer those lowest prices Sam Walton built the company on.
Still comes back to price.
Often, yes. Then their powerful omni-channel capabilities, especially using their physical stores as fulfillment centers, give them a unique advantage over purely online players and traditional retailers who haven't adapted as quickly.
Makes sense.
Their defensive business structure, driven by that massive grocery segment we talked about, provides inherent stability no matter what the economy's doing. The Walmart Plus membership is a direct strategic counter to Amazon Prime, aiming to build loyalty through perks like free delivery and fuel discounts.
Building that ecosystem.
Exactly. And crucially, their expansion into high-margin new businesses like Walmart Connect Advertising and Walmart Health are vital for diversifying the revenue streams and improving overall profitability. These are areas many traditional retailers just aren't equipped to pursue.
That's a really comprehensive picture of the competitive landscape. Now let's zoom out a bit. How do broader macroeconomic trends, big picture stuff, ripple down to affect a company as massive as Walmart?
Oh, these external forces are absolutely critical for understanding the investment picture. You can't ignore them. During times of strong economic growth, you might see increased discretionary spending, which is great for their general merchandise, sales, clothing, electronics, etc.
People spend more when times are good.
Right. But a recession could cut into that significantly, though that stable grocery demand provides a significant cushion, as we discussed.
The defensive part kicks in.
Exactly. Inflation is a real double-edged sword.
Right.
It pressures consumer purchasing power, making every dollar count, which could hurt spending. But it also directly impacts Walmart's own operating costs. Fuel, transport, wages go up.
But doesn't their low price image help here?
It can, yes. Walmart's low price image can be a powerful hedge during inflationary periods. As consumers actively seek value, they might trade down to Walmart.
Interesting. What about interest rates?
Interest rates. Higher rates can reduce consumer disposable income because mortgages and loans cost more. They can also impact corporate investment plans if borrowing becomes more expensive.
And jobs.
Strong employment and wages generally boost consumer spending, which is great for retail overall. But rising wages also directly increase Walmart's labor costs, as they're one of the largest employers in the country.
A huge wage bill.
Massive. Supply chain stability is another big one. Geopolitical risks, shipping disruptions, port congestion, all that can significantly affect their margins and inventory levels.
We saw that recently.
Definitely. And finally, currency fluctuations can impact the revenue from Walmart International when it gets converted back into U.S. dollars for reporting. A strong dollar can make international earnings look smaller.
So many moving parts.
Indeed. All these broader trends are essential for your investment decision, even for a company as large and diversified as Walmart, because they paint the economic environment in which it operates and ultimately affect its ability to thrive.
Okay, so given all those external pressures, intense competition, shifting consumer habits, those macroeconomic headwinds, what are the key challenges that Walmart specifically faces? The risks investors should really be aware of.
That's a really important question. Despite its immense size and strengths, Walmart is certainly not immune to headwinds. I'd say the most significant is ongoing online competition and margin pressure.
Still Amazon.
Amazon remains a persistent threat, yes. And just generally, online sales often have lower margins than in-store sales, mainly due to logistics and delivery costs. As e-commerce grows as a percentage of their total business, this could dilute Walmart's overall profitability if they can't manage those costs effectively.
The cost of convenience.
You could say that. Then there's inflation and consumer spending weakness. If inflation persists, or if we hit a deeper recession, consumers might really pull back on discretionary items. The clothing, the electronics, the home goods impacting sales beyond the essential groceries.
People stick to necessities.
Right. The labor market and wage inflation are also critical. As one of the largest private employers in the U.S., any significant minimum wage hikes or increased union activity could substantially raise their operating costs.
Always a pressure point.
Always. Global supply chain instability remains a concern. Whether it's from geopolitical issues, climate events, or other disruptions, it can lead to delays, increased shipping costs, and tricky inventory management challenges.
Got it. Tech risks.
Absolutely. Like any massive tech-enabled company today, they face significant tech and security risks. Think cyber threats, potential data breaches. These could seriously erode customer trust and incur massive costs, plus the risk that some of their big tech investments just don't pay off.
And legal stuff.
And finally, yes, regulatory and legal risks. Things like antitrust scrutiny, given their size, or new consumer protection laws, environmental regulations. These could impose additional compliance burdens and costs. Understanding these risks is really crucial for a complete investment picture.
That paints a challenging landscape, for sure. But what about Walmart's inherent internal strengths? What's its armor against these risks, and what fuels its future growth from within? Where do they fight back?
Right, that's where the analysis shifts to their capabilities.
Yeah.
Walmart's leadership and vision are definitely key here. Their strategic focus on executing that complex omni-channel transition and proactively expanding into those new high-growth areas like healthcare and advertising shows significant foresight.
It's not just reacting.
No, they seem to be playing offense. Then there's technology and innovation. We're talking about robust e-commerce platforms, but also advanced logistics effort. Automation robots in warehouses, AI for inventory management, and sophisticated data analytics for personalization. It's all aimed at improving efficiency and the customer experience.
Investing heavily in tech.
Very heavily. Talent acquisition and management is also crucial and may be overlooked. They're actively attracting diverse expertise, not just in traditional retail roles, but in tech, in data science, and healthcare, to actually staff and run these new ventures effectively.
Bringing in new skill sets.
Exactly. Their financial health and capital allocation are rock solid. That strong cash flow allows for efficient capital deployment investing back into the business, paying those reliable dividends, buying back shares, all while managing debt responsibly.
Financial discipline.
Yes. And underpinning it all, back to where we started almost, is their immense supply chain and scale strength, that massive purchasing power, and that extensive global distribution network. It simply can't be replicated easily by competitors. It's a deep moat.
So those internal strengths are formidable.
They really are. These are truly Walmart's inherent advantages against the risks we discussed, and they're the fuel for its continued growth and evolution.
Okay, so pulling all these different threads together now, the strengths, the weaknesses, the opportunities, the threats.
Yeah.
What's the integrated investment judgment here? For the American investor listening, what should they really take away from this deep dive?
All right, if we synthesize all this analysis, here's sort of the verdict. On the positive side, Walmart remains a fundamentally defensive stock thanks to that huge grocery stronghold. It offers strong price competitiveness, which resonates in almost any economy. It has executed a remarkably successful omni-channel strategy, integrating online and physical effectively.
The dividend, too.
Absolutely. It's a consistent dividend growth stock, a true dividend aristocrat, which is a big plus for income seekers. And it possesses significant new business potential in those higher margin areas like advertising, Walmart Connect, and healthcare, Walmart Health.
Okay, those are the positives. What about the cautions?
The risks are real and shouldn't be ignored. There's intense competition, especially from Amazon online, but also from specialists and discounters. There's the ongoing pressure from inflation potentially impacting consumer purchasing power, especially for non-essentials. There are rising labor costs as a major employer. And there's the inherent challenge of maintaining and improving online business profitability given those higher fulfillment costs.
So what should investors watch?
For you as an investor, the key watch points moving forward should be monitoring their e-commerce growth rate. You want to see that it remains robust. Look for signs of margin improvement across the business, not just revenue growth. And closely track the performance of those new higher margin businesses like Walmart Connect and Walmart Health. Their success, or lack thereof, will be really key to unlocking future profitability gains.
So what does this all mean for you, the American investor listening right now? Our conclusion, based on the analysis, is that Walmart provides substantial stability and consistent dividends. That makes it potentially an excellent choice for long-term investors seeking portfolio stability, especially in uncertain economic times.
It's proven its resilience.
It really has. It's a company that has shown its adaptability over decades. However, for those seeking truly aggressive growth, it might require a more nuanced view. Its future growth prospects are pretty tightly tied to continuous innovation and finding efficiency improvements in what is a fiercely competitive market.
Growth won't come easy at this scale.
Right. Ultimately, Walmart's blend of stability, that defensive grocery business, and those consistent dividends makes it a compelling consideration for investors prioritizing portfolio anchors and perhaps a hedge against economic shifts.
So here's a final thought to leave you with. This raises an important question. As Walmart continues its evolution, how much of its past success still relies purely on its vast physical infrastructure? And how much of its future will really be built on pure digital innovation and these new ventures? What do you think?
That's a great question to ponder. If this deep dive was helpful for you, please do consider subscribing. We'll be back soon with another deep dive unpacking the insights you need to stay well informed.